Hey guys, welcome back to another episode. In this video we will be going through our very profitable moving average setup and trading strategy. If you want more videos more often, please smash the like button, subscribe, and turn on the notifications bell, and share this video across your WhatsApp, Facebook accounts, or Twitter to show your support. A very important point before we start. Everything we discuss in this video can be used for currency trading, stock trading, and crypto, because price action stays relatively consistent across different assets, so we're going to go very in-depth in this video. The 50-period moving average indicator is one of the most important and commonly used tools in Forex and stock trading. Considered an intermediate term indicator, it is a multiple of the longer term, 100 and 200 moving averages. Its use is ubiquitous on any time frame. Therefore, it goes without saying we need to unpack the relevance of this average and how you can use it when trading. To this point, we will give a brief overview, elaborate on the 6 tips, and then show some trading examples using the indicator. Lastly, we will show you where the indicator can fail you, so you are prepared for when things do not go as planned. Why use a moving average? The moving average is a trading indicator used to smooth the price action on the chart. The moving average indicator takes into account a certain number of periods when calculating its value. These periods can be adjusted, which also modifies the appearance of the line on the chart. The more periods it takes into consideration, the smoother the line. Let's say we want to calculate the 5-period moving average for the following values: 3.57, 4.16, 8.73, 10.41, 12.63. The 5-period simple moving average would equal 7.9. For each new period, the formula accounts for the additional data point. Therefore, the moving average is a lagging indicator. The reason for this is that the moving average needs a given number of data points based on prior periods to print a value. The purple curved line on the chart is a 5-period simple moving average. This line is not smooth at all. This is because 5 periods is such a small time frame and will result in many trade signals. More signals than most would care to track. Now that we have provided a visual of a moving average, let's dig into the 50 period to see a longer time frame. What is a 50-period moving average? The 50-period moving average indicator is one of the most common SMA in Forex, stock, and crypto trading. As you can see, the 50-period SMA is much smoother than the 5-period moving average. This will naturally result in less trading signals and an increased significance on breaches of the average. 6 essential tips for how to use the 50-period moving average. Now that we have discussed the structure of the 50-period moving average, let's dive into the 6 essential tips for how to use the indicator. First, asset price above the 50-period moving average is usually considered bullish. Second, asset price below the 50-period moving average is usually considered bearish. Third, if the price meets the 50-period SMA as support and bounces upwards, consider a long entry. Fourth, asset price meets the 50-period SMA as resistance and bounces downwards, consider a short entry. Fifth, if the price breaks the 50-period SMA downwards, you should switch your opinion to bearish. Sixth, if the price breaks the 50-period SMA upward, you should switch your opinion to bullish. These 6 rules are crucial for understanding the character of the 50-period simple moving average indicator. They may sound like they are all saying the same thing, but they're not. Notice how we never said that you should just buy and sell based on the 50-period moving average. Trading doesn't require an advanced degree, but we are here to tell you that buying and selling solely on the 50 is not a strategy for success. However, having a base understanding of these 6 principles will help you better navigate how to trade with the average. Next, we will explore these strategies and areas where the indicator can fail you if not used properly. 50-period moving average trading strategy. In this trading strategy, we will lay out the entry, exit, and stop loss when trading. You'll likely notice that this strategy resembles a trend-following strategy. 50-period moving average trade entry. To enter a 50-period moving average trade, you should wait for a breakout. Whenever the price breaks the 50-period SMA, you should open a trade in the direction of the breakout. In most cases, the price action will continue in the direction of the breakout. '50-period moving average stop loss. Every 50-period moving average trade should be protected with a stop loss order. Nothing is sure in trading. The 50-period moving average strategy is no different. In the long term, we expect the price action to continue in the direction of the breakout. However, there will be cases when the price action will surprise us. The price action could sometimes rapidly shoot in the opposite direction with a big candle. This could happen due to the release of some unexpected report. The ideal place for our stop loss is beyond a price edge created prior to the signal we use to enter the trade. If the price breaks the 50 SMA upwards, we need to go long, placing a stop below a bottom prior to the breakout. If the price breaks the 50 SMA downwards, we need to short the stock, placing a stop above the top prior to the breakout. '50-period moving average profit targets. One of the simplest tactics for establishing a profit target is to use a fixed reward to risk ratio. Based on your entry point, it will require your stop loss level. This stop loss will determine how much you are risking on the trade. The profit target is set at a multiple of this, for example, 2 to 1. Trading example with the 50-period moving average. Now let's approach a real 50-period moving average trading example. '50-period moving average versus 200-period moving average. Another important moving average is the 200-period moving average. We mention this tool because it creates a very strong signal when used in conjunction with the 50-period moving average. This signal is known as the golden cross. The golden cross is a signal created by the 50-period moving average crossing through 200-period moving average to the upside. This signal is known as the death cross. The death cross is a signal created by the 50-period moving average crossing through 200-period moving average to the downside. A good golden cross and death cross trading strategy is to open trades in the direction of the cross. Where the 50-period moving average is likely to fail. Breaking the average. The 50 is a major trend-following average to use on the chart. To this point, what you do not want to do is overreact if a stock breaks the average on 1 or 2 candlesticks. We like to call this porosity. It's like a cow leaning through the fence to see if the grass is greener on the other side, only to return back to the same pasture. This is often a rookie mistake to make, as the stock will likely recover and continue in the direction of the primary trend. The key is price action signal. Price action describes the characteristics of a security's price movements. In simple terms, price action is a trading technique that allows a trader to read the market and make subjective trading decisions based on the recent and actual price movements, rather than relying solely on technical indicators. Here are other examples of the 50-period simple moving average trading strategy. 50 and 200 period moving averages are probably among the most commonly found lines drawn on any trader or analyst's charts. All two are considered major or significant moving averages and represent levels of support or resistance in a market. As always, if you learned something new, or if you want more videos more often, make sure you subscribe, click the notification bell, and share this video across your WhatsApp, Facebook accounts, or Twitter to show your support. See you next time.